Mary, were you there?
No, Jesse, I wasn't.
Mary Holm, personal finance expert, knows better than to be spending thousands of dollars getting into the snake pits at the Metallica
spent
concert.
a few $1,000s getting into a few other snake pits. Yeah,
They're getting more and more expensive concerts.
Yeah. Yes.
I think they've got a real policy of turning it up to the absolute max so they don't leave $1 on the table.
Yeah, and they don't make so much these days from records and things, I think.
Yeah.
Is that right?
That would be correct, yeah. So they
Yeah.
make them from touring.
Yes.
Anyway, I don't think there were many people leaving last night who thought they wasted their money. It was a brilliant night. But hey, welcome in.
Thank you.
For your fortnightly slot. And you're taking a moment this week to address some of the feedback we've had over the last few weeks.
Yes, well, we get quite a lot of people who enjoy our conversations, giving us that wonderful feedback, and thank you for that, everybody. It's when people are unhappy that I feel I must respond, because I don't like it sort of hanging out there with people thinking, oh, she got that wrong.
Yeah.
And so there were there was one that followed our last session, and then there was another one that came a few weeks back. So I thought we should address those two complaints, really. They were unhappy listeners, I would say.
You never want to hide the complaints, Mira. You're always up front.
Well, you have to be, really, don't you? Otherwise they go and tell all their friends.
Okay, can I read this one?
Sure.
So a listener emailed to say that last time, quote, you said that it can be cheaper to rent when you're older versus paying rates, insurance, maintenance on your own home. I disagree with that comment, as unless you own an expensive house with high rates, I believe your statement was incorrect. I own, with no mortgage, a modest 3-bedroom house in Grey Lynn, Auckland. My rates and insurance combined are under $8,000, and maintenance would average out at less than $7,000 a year. Gosh, you'd hope so. There's no way I'd be able to rent a house in Grey Lynn for under $15,000 a year. I've got friends living across New Zealand from Dunedin, Timaru, Blenheim, Palmerston North, Nelson, Auckland and Wellington, whose rates, insurance and maintenance are significantly less than renting in those areas. Can you clarify if you are only focusing your comments on the real wealthy property owners, as your rental versus owning when older doesn't stack up with all the people I know across New Zealand?
Yeah, and she ended up by saying she was disappointed, and I thought, I think she should be happy because she's actually doing quite well on the housing front. But I went back and listened to our session because I thought I don't think I was talking about older people, and I wasn't. I was talking about younger people who are looking to get into their first home and trying to save up for it and renting in the meantime, and she's welcome to go back and listen to it on my website or your website. It's cheaper to rent. I didn't ever say it was cheaper to rent when you were older. I was talking about younger people. And I did, to underline that, we've always said if you're going to be renting in retirement, then you've got to save more, because when you get to retirement, you've got to cover your accommodation costs. And that implies, of course, that renting does cost more than home ownership in retirement. But the big difference between her costs and the costs of a younger person are mortgage interest. Paying the principal is actually saving, it's building up your capital. So that's one thing, but paying mortgage interest is just simply an expense, just like rates or maintenance and so on. And so I probably, when I spoke, I said, tends to be cheaper to rent than to own a home, quote, what with rates and insurance and maintenance and all of that stuff. And I didn't actually specify mortgage interest.
Right.
Perhaps I should have.
Yeah.
But I'm sorry if she was upset about it, but the fact of the matter is that home ownership, once you've got rid of the mortgage, will nearly always be cheaper than renting, unless you suddenly get a huge maintenance bill.
Which does happen.
And it absolutely can. Suddenly roofs are things that quite often suddenly somebody finds their whole roof's kind of rotting away and they need to replace the whole thing, or there are various times when suddenly you get this horrific big maintenance bill. But for the most part, yes, our listeners, right, that when you're older and you got rid of the mortgage, then it's cheaper to own your own home than it is to rent.
Thank you, Mary. Okay, on to another piece of feedback, and this one's on investment strategies and what works best. And someone sent a text with this message. Mary Holm focuses on single sector funds like equities. She doesn't seem to believe the research that says that changing asset allocation is more important than stock picking. Funds like Milford Asset Management have outperformed other funds by switching from shares to cash and bonds at times.
Yes, and I thought actually before we talk about this, I should define some of those terms because it's a little bit technical for a lot of listeners probably. So he was talking about single sector funds, which means funds that invest only in shares or only in bonds or only in property. And he was also talking about equities, single sector funds like equities. Now, equities are just shares.
Yeah.
For some reason, people in the industry like to call them equities. I think it's partly just to make it all sound a bit hard. But so single sector funds like equities, what he's talking about is share funds, funds that invest in a lot of shares. And he's also talking about asset allocation, and that is about how much of your money you put in, say, bank accounts and bank term deposits versus bonds versus shares versus property. That's allocating your money to different assets. So, and he says, I don't seem to, by the way, he misspelt my last name, but never mind. It's all right.
As if you were the
Related to Paul
sister
Holmes.
of the late Paul. Yeah.
Yes, that's right. Yes, yeah. So my name's just HOLM, but that's irrelevant. He said she does not seem to believe the research that says that changing asset allocation is more important than stock picking. Now, I've never sat here and said stock picking is a good idea. I don't know where he got that idea from. So stock picking is when you're going through and choosing to invest in company A and not in company B, and what tends to go with that is that you're buying and selling. You get out of company A after a while because you think its price has got too expensive. Or so people who are stock pickers are people who are picking which particular shares to get into and which ones to get out of, and tend to invest in only a few shares. If you really like doing that, I would recommend you at least invest in 10, if not 20 different shares in different industries, because otherwise, I mean, at the moment you get people who are really into AI stocks, American AI stocks, and I was talking to someone recently who had quite a few different investments in different AI companies. That's dangerous stuff because you're all in one industry, and especially an industry like that could be
Well, interestingly,
very
I was
volatile.
reading a piece recently about people being exposed to AI without even really realising it. Like if you have money in commercial property in the US, then that's
Yes.
inevitably going to have some sort of data bank. If you're investing in a air conditioning company, the other people who are putting the air conditioning systems in these giant sort of computer farms, and almost the entire economy is some way linked to this. And they were making the point that if AI is a bubble, it's going to affect everyone, not just people who are investing in NVIDIA, who had pretty good results this morning, by the way.
Yes, so far.
So far.
Yeah.
Anyway, that's
Yes.
just by the by.
No, and one thing that happens when a particular industry gets the shares in that industry grow fast is that if you're in an index fund that's based on the S&P 500 is the big American index, you're going to have an industry that's popular its share prices are going to go up, and so it's going to have more and more weight in that index. And so anyone who's invested in the broad American share market has got quite a lot in high tech and AI in particular. But hang in there, and it might go down anytime soon, and it might not. And I was writing about it in my Herald column a while back, and saying that a woman I talked to recently said someone was urging her to get out of those high-tech stocks a year ago, or out of an index that had a lot of these stocks in it, and because they said it was a bubble, and if she had, she would have missed out on huge returns in the last year. So it's got to be long-term money, and you get in there and stay in there and don't start messing around about when
you don't react to stuff that happens.
No, just the share market will go down sometime in the future, and it might be today and it might be several years away, and we don't know how much it'll be, and just ignore it. Put your long-term money in it. So just getting back to this man's rather cross text. So he's talking about changing asset allocation versus stock picking, and I don't advocate either, really. What I want people to do is invest in index funds or ETFs that spread your money over a whole lot of different shares, and don't start working out when the market's going up and when the market's going down. Now, he is quoting Milford, which has done really well in the last 10 years with its KiwiSaver and non-KiwiSaver funds, and part of that has been that it has moved its money in and out of shares and bonds, depending on what it thinks the market's going to do, and it's done well at it. And any number of other KiwiSaver and non-KiwiSaver funds have tried to do similarly and haven't done as well. And, the point is that Milford won't necessarily keep doing as well. I mean, when you look at the research, he's saying that I'm not keeping up with the research, but I do, and I've got an MBA in finance, and I've been reading this research for decades. And the research shows that it's very rare indeed for any fund manager to keep doing better than an index fund, which is basically a sort of market average for years and years.
That's true of people who are buying and selling stocks and people who are moving money around between assets?
Yes.
Yeah.
Yeah. Yes, I would say so. Those funds do well sometimes, and there's always going to be, in any decade, a few that keep doing well for a whole 10 years. But the research that I was looking at recently, now it's American research, although they're starting, the Americans, S&P, Standard & Poor's, are starting to do research on New Zealand equity funds as well, and finding similar results, that in a single year, the actively managed funds that can move money around in and out of assets, about half of them will beat the index funds, but once you get over 5 years, it's not nearly half, and once you get over 10 years, it's fewer again. And so, by all means, go with an active manager if that's what you prefer, but that's not where my money is, and it hasn't been for a long, long time.
All right, those are our people today. That's Homes Tonight. Just teasing you. Thank you, Mary. And if people would like to feedback on that, they can do so in the usual places. Jesse@rnz.co.nz.
Yes, and we might next time have to answer some more crabby
or
messages.
Text us on 2101. Great to see you. Thank you.
Thanks, Jess.
Mary Holm's our personal finance expert, and she's been coming in for a good number of years now with some great advice. Well, we don't call it advice because actually we get into all sorts of legal trouble. It's not advice, but it's wisdom, I guess, from over the years, and some principles to keep in mind when you're dealing with your money.